America mulls sanctions on Russia. Here's how they could do it.
And the stuff is also quite heavy, as you know.
Well, hello there, my friends. Chris Marcus here with you for Arcadia Economics on Wednesday, May 21st, just before noon. Where, as you can see, as our chart comes up here, we have another rally in the gold and silver market. So there is gold up $30 back over that $3,300 mark. And why don't we take a quick look back at the 1 month chart here? You can see close to actually over the 3,500 at 3,504. That was back on April 21st, and then quite a sell-off. So down to 3,140. And now life is good in gold and silver land again as we are back up over the $3,300 level. Also, another strong day for silver, up 45 cents, and that has been climbing as well. If we take a look at our 1 month chart, you can see back there below 32 bucks, now within range of 34, and still 2 days left before the holiday weekend. So we will see how that all shakes up through the end of the week. As you might imagine, dollar index down by a decent amount and back below par at 99.38, 99.40. So something we will touch on. And obviously, as you saw in the title of today's video, wanted to talk about the possibility of additional sanctions on Russia, which we've mentioned in the past couple of weeks, but continues to be in the news, coming out and proposals about that. Certainly, we've seen what happened since the last round of sanctions on Russia. Whether you agree or not that they should have been sanctioned from a financial perspective, that's right when the central banks started buying gold. So we will dig into the developments there, where it sure seems like something has changed in the last 3 or 4 weeks. And at least we will highlight what they're doing. But other thing we will get into today is a lot of rising rates. So here is the US 30-year bond chart. Can't even imagine. I mean, tied to the US Treasury for another 30 years. You hear talk about them launching the 50-year, and you can see we're really, this is the 5-year chart, and here we are. This is the long term. You can see it's been quite a while back here since 2007 when we had 30-year rates this high. And that wasn't really the ideal time to be holding mortgage assets, at least. And in either case, and all the other associated pressures that it puts on an economy. Yet here we are back above 5% with the yields up 5 basis points today. And as we'll see, especially in Japan, not going particularly well. Here is their 10-year yield. This is the 5-year. So you can see this is we're getting a new territory here. And also here is the 30-year. And interesting when you look at that, really been spiking in 2025 here. So we will dig into that, but let us get, now that we've taken a look at the pricing, America mulls sanctions on Russia. Here's how they could do it. Now, this one was from last week. We reported on a story from the Telegraph after Trump and Putin had a meeting where, again, we heard during the campaign trail we could end the war in 1 day. He said later he was joking about that in an article that I read. And neither case seems like the tone has changed, because in that Telegraph article, they mentioned how their title was Trump turns on Putin, and mentioned additional banking sanctions. And then here we have, that was the threat issued by Lieutenant General Keith Kellogg, the U.S. Special Envoy to Ukraine. And this was from an interview on Fox News. And he said Vladimir Putin has been warned that drastic new U.S. sanctions were ready to go should he come to be seen as the main obstacle to peace. Interesting there that he says ready to go. So it's not they're thinking about it, at least from the phrasing there, that we've done more than thinking about it. We have them ready. So just a different level in the chain of events between here and there. But then if we scroll down a bit to the Sanctioning Russia Act section, it just doesn't sound good. And it's not, the next sentence, it's not going to sound better, unfortunately, because The U.S. is now exploring what would effectively be the nuclear option, which is certainly never good to hear in these situations, especially when they're also talking about literal nuclear options at times. I have heard military folks in videos I've seen talk about their plans, and I don't know if the nuclear option is Lindsey Graham himself, although he has widespread support in Congress for the Sanctioning Russia Act of 2025 that would impose a 500% U.S. tariff on goods from nations that buy Russian energy. So not just on Russia, but nations that are buying energy from there. China, India, Turkey, and Brazil would be forced to find alternative sources to retain access to the U.S. market. The extension of sanctions on the central bank could further complicate trade. Yes, I think that would be safe to say. Graham says this is a bill. The bill is a tool in President Trump's toolbox. Scott Bessent talked about all the options in their toolkit for bond buying. And Graham, who is quoted here as being a close ally of Trump, whether that's the case or not, I'm sure there's multiple schools of thought there, but says that when he believes that we've reached an impasse, then watch for action. There's a team working on hammer sanctions in the US government that gained prominence recently over figuring out carrots to offer Moscow, says Tom Kittinge of the Royal United Services Institute, London-based think tank. Always great to have London involved in these decisions. Can only imagine what Tom Luongo would comment about that one. Although, again, not just Lindsey Graham, because here we have General Kellogg explicitly referencing the bill as the source of the very serious sanctions, pointing at Moscow. Now, whether Trump would actually do that, I guess we'll see. I mean, certainly a rather unpredictable time. Hope not. We still hear the died down recently, but we continue to hear whether the US or Europe that they want to just confiscate the frozen Russian assets, but all of which, what now? Why is this important, gold and silver boy? Because if we look back 5 years, you can see, well, I guess you don't see it on the price chart, but really at 2022, after those sanctions were placed and Russia was kicked out of the SWIFT system, that's when you have central banks starting to set records for gold buying, which has continued on since now. And as you're going to see, in the midst of this potentially happening, we're not exactly in the best rate environment for the global government bond racket, if you will. And let's take a look at some comments that came across. And thank you to Craig Hemke. I'm a subscriber to the TF Metals Report, which I'm quite proud of and love his column. And sometimes I end up with 3 or 4 of them stacked together before I get to them, but anyway, he's been doing a great job of covering this, and a few that notes that he had here. Here we go. Oh boy. Global 30-year bond yields from Europe to North America to Asia are a screaming emergency. Let's make this one bigger a little bit so you can see here. And there's the US down there, and here's Japan, and you can see a pretty consistent picture. So on to our next clip. Here's Ed Dowd, Black Swan Watch for the BOJ. The Bank of Japan is caught between responding to their weak economy, stimulus, or torching the yen carry trade to protect their currency by raising rates. And obviously, I'm guessing you remember within the last year, I think it was last August, maybe when we woke up one day and the Nikkei was down 12% because of that carry trade. And that's another situation that has not been resolved, but is just lingering on out there. And our dear old friend Rafi Farber does a great job of covering that. So, and his YouTube channel, Rafi Farber. So you can check that there if you'd like some more of the in-depth dynamics, although we'll keep it rolling today. Here's someone who apparently Rafi would probably not like because he's taken the endgame title, but mentioned for the second day in a row, there have been no buyers, literally no bids for Japan's 30-year and 40-year government bonds. Yields on both have exploded higher, with the 40-year jumping past 3.36% and the 30-year hitting 3.16%. These are massive, sudden moves that point to one thing: something is breaking beneath the surface. Keep in mind that the Japanese finance minister, who about a month ago had said we will not consider selling U.S. treasuries as a leverage ploy in the trade deal, and then this past month said that we cannot promise we will not do that. So there's that in play. And then Zero Hedge asking, does the Bank of Japan immediately go back to a negative interest rate policy and yield curve control to save its bond market and spark inflation and currency collapse? Or does it do nothing and watch as plunging bond prices trigger a cascade of local bank failures? History would show it's the first, and I still remember the days of Shinzo Abe campaigning on his hyperinflation campaign platform. I believe he's still viewed quite favorably there. So I'm going to go with option number one with my 2 ounces. And then here's Richard Christopher Whalen. And I think this is the same Christopher Whalen who was a Fed governor at one point. But I've heard many of his comments over the years. And he says, Japan's bond market is imploding. 30-year government bond yield has officially surged to its highest level in history. For decades, Japan was known for long-term interest rates. Now they are dealing with high inflation, shifting policy outlook, and a whopping 260% debt to GDP ratio. All right. On top of this, Japan holds 1.1 trillion worth of US debt, which now they are bringing into the equation could be for sale, making it the largest foreign holder of US debt. And of course, the second largest holder is China, who does not seem like they are going to be buying a big new chunk of US debt in the near future. And then just to top it off, yesterday, Japan's Prime Minister Shiba called the situation worse than Greece. All right. It's encouraging news in the bond market. But fortunately, there's more because in the midst of that, as you would have heard about if you were a subscriber to the Arcadia Gold and Silver Daily on Substack, which could be found at goldandsilverdaily.substack.com, that Jerome Powell actually had an interesting appearance last week where he said strategy around both jobs and inflation needs to be reconsidered. First of all, the idea of the 2% inflation mandate, I don't know that that's quite like the gods of the Federal Reserve came down with the tablets that said that. And if you go to this link on the Substack, I'll put that one in the description field below. It's great to hear Judy Shelton talk about how even Alan Greenspan and Paul Volcker at separate times both acknowledged that the idea of a low inflation policy was an obvious scam. That she says Paul Volcker said, my own mother would have seen through that as an obvious scam. Interesting clip there. And but anyway, if we get down to the real action there, at our meeting last week, we had a similar take on average inflation targeting. We will ensure that the new consensus statement is robust. I wonder if they really talk like that in meetings with robust and all those Fed words and transitory and a wide range of economic environments and developments. His comments point to possibly extensive revisions to a strategy that had been viewed at its inception as a major shift for the Fed, with a willingness to take more risks in favor of a stronger job market, and right there, a willingness to tolerate higher inflation after periods of weakness. The other part that I skipped over earlier was that he basically said we're in that period of weakness. Oh, yeah, right here. We may be entering a period of more frequent and potentially more persistent supply shocks, a difficult challenge for the economy and for central banks. So he's already saying we're in a period of weakness. And then down at the bottom, he tells you what he's going to do after that period of weakness. Might add that in this one session, also said that longer term interest rates are likely to be higher as the economy changes and policy is in flux. So that means that the borrowing expense will also be higher while we're cutting off most of the foreign lenders. I mean, the big two, they're giving all sorts of indications that they're not going up to the buffet and asking for a second serving. And while that's happening, keep in mind Walmart's tariff price hikes are likely just weeks away. Retail China is likely to start rolling out tariff-related price hikes towards the tail end of this month, and I certainly expect more in June, said their CFO, David Rainey, on CNBC. So while Trump has said that there's no inflation and the Fed, despite being over their old inflation mandate, soon we'll have a new one, it sounds like, and that even despite that, it's going to take another 3 years to get down to 2%, which would have made it 6 years in total, given it's been 2021, I believe, since we were there. And they're going to pull this off by lowering interest rates. Well, so far that inflation forecast does not seem to be on track to come down. Quick look at some gold and silver positioning before we wrap up here. As here you can see the gold picture and quite a bit of short covering over the past month, I believe that would be. They were short a record over 250,000 contracts. Now that's under 150,000. So fair amount of short covering in gold. And interesting, let's see if we can get a 2 year version of this, because as I was looking at this yesterday, you see, all right, here is where the banks were most short. Once they started covering, see, they started covering, and then right as that last chunk of the rally began there. So doing all right, depending on how hedged or unhedged they may be. Here is silver, a little bit of a different picture. We did the all-time peaks back from July of 2016 still. We came to second place, then broke that three times in the past year, and a little bit off the most extreme levels, but still relatively short and not quite the same profile as gold. And then our final note, I saw someone share this and they were mentioning this is really bad for gold. Scientists can literally recreate gold in a lab and make gold no longer scarce. And once people realize this, there will be a big shift into Bitcoin. I did not go through his full report, although I have heard the interview with a gentleman David Morgan interviewed named Ken Schwartz, who actually talked about whether gold alchemy has become possible. And the short answer, come on, let's get a little visual there of our friend Ken. A little slow on the YouTube today, but Ken did mention that it is possible, but it's like, do you have what is the cost? And with some astronomical cost. So, I mean, if you could alchemize gold for $1 million an ounce, maybe, you get a quirky donor who says, I'll take one, but you're not going to continue to mine them. Similar, I hear people say, is there gold and silver on asteroids? I mean, there may well be. What's your all-in sustaining cost on the asteroid deposit? Similarly, I know Bix talks a lot about gold in the Grand Canyon. I don't know if there is gold there or not, although you have to go down the Grand Canyon. That's not going to be an easy place to mine. So what does that ultimately come out to? Just something that when you see stuff like that, remember that's also an important part of the equation. And anyway, if you want to find out what Ken had to say, that is the title of that one. I'll even throw that in the description field for free too. And with that said, I would just like to thank Fortuna Mining, who kindly brought us today's show and did have a small bit of news out this morning as they have released their sustainability report. And that will also be in the link below. So if you want, you can take a look through the details. Although having visited two of their mines, their Seguela mine in Cote d'Ivoire in West Africa, as well as recently seeing the Lindero mine down in Argentina, and learning how to say it properly finally. But I've seen firsthand that these are well-run operations. This isn't where, I mean, if someone came on there, acting wild, I mean, it's not the type of behavior you have there. So I know they do pay very close attention, especially at Lindero, where it was a higher altitude. There was a lot of steps taken to make sure people were safe and checking in. And as you may have seen on our last call during their covering their earnings, I struggled with the altitude, but everything was, you could tell it was professionally done. And if you would like to read through their sustainability report, link is in the description field below. And I'll also link as we wrap up here to that earnings call I just mentioned from 2 weeks ago, where they had record free cash flow, certainly helped by the elevated gold price. And especially after the closure, or the sale rather, of the Yaramoko and San Jose mines, getting down to an overall lower cost per ounce as they remove some of the higher cost mines. And anyway, Jorge talks about all of that and more, and that one is coming your way now.
And the stuff is also quite heavy, as you know.